This is our first of 3 dividend activities. So real quickly, it's a pretty quick idea. We declared cash dividends of $10,000 on April 1st, to shareholders' record on March 1st, and we made the declaration on January 1st. So GAAP says we're going to record the owner's equity effects of the dividend on the date it's declared, so we have to do a journal entry on January 1st. That's the date we're obligated to pay it. So companies can choose to use a dividends account or retained earnings. So I will let you do the same thing. You pick whatever you want to use. I'm going to use a dividends account in my entries here, but you could just as easily use retained earnings. That means on your project you could use retained earnings as well, rather than putting in a new property dividend account. You could just use retained earnings. All right, so looking at what we would record, we want to recognize that we've got this dividend declared, so that would be a debit to dividends or retained earnings. Okay. Makes my owner's equity go down. This example, it's $10,000, pretty straightforward. I didn't actually pay that cash out on January 1st. This is my January 1st entry. So I'm going to put, you guys know this, dividends payable, payable for $10,000. So that's on the date of declaration. Question 2, ask you, is dividends a temporary or a permanent account? And you know it is a temporary account, which tells you it gets closed at the end of the year. Okay. Question 3 is a think about question. Do dividends show up explicitly on the balance sheet or income statement or statement of comprehensive income? You know the answer is that they are not. Whoops. Tell you the answer. No dividends on the balance sheet. You know that. They don't show there. No dividends on the income statement. There are no dividends on the statement of comprehensive income. If you're going to look, where in the financial statements do I see the line dividend? There's 2 places you'd see it. You'd see it in the statement of cash flows. If there were dividends paid, they'd show up in the financing section as an outflow, or you would see them also, I said and, I guess, you would see them on the statement of shareholders' equity. So the answer to question number 3 is no. They do not show up any of those places. All right, so what happens on the date of record? The date of record is when you just establish who actually gets the dividend check. So that does not require a journal entry. And so then finally, what happens on April 1st, when the dividend is paid, we're going to pay out cash of $10,000, and we're going to reduce the dividends payable. That's very straightforward. Dividends payable. And that takes care of this one. Cash dividends, they're pretty straightforward, pretty easy. Don't make them harder than that, right? Common cash date activities is cumulative preferred shares. So looking at a cumulative preferred share example gives us a chance to talk about what that means. So a couple of things. We have $200 million in common stock. It's no par. We have $400 million of 6% preferred stock. What does that even mean? Okay, what that means is it's cumulative. So that means the preferred shareholders accumulate dividends equal to the stated amount for each period they own the shares, right? So these are 6% shares. That 6% refers to the $400 million, and that's basically the rate of dividends they are entitled to each year. So what is the yearly amount of dividends for that? For these preferred shareholders, we would say 400 million times 6% equals 24 million. Okay, so every year, the preferred shareholders, obviously not a piece, but in total are entitled to 24 million in dividends. All right, so then we have some information about the history, and we see that in 2011 and 2010, the board of directors only declared cash dividends of 20 million. So in those years, how much in dividends did the preferred shareholders get? Well, they got everything. They're entitled to 24 million, but if there's not 24 million, whatever is declared, they are going to get. All right, so I can, was there any excess that needs to roll over? Yeah, the excess just rolls over from year to year. So in 2010, there was 4 million. And then in 2011, there was another 4 million. That wasn't paid out for that year. Okay? So that equals 8 in total. And that 8 is referred to as, it's a little bit smaller so I can write this. This is referred to as, oh gosh. It's referred to as dividends in arrears. Okay, there's 8 million dividends in arrears. All right, how much did the common shareholders get? Well, the preferred shareholders get their money first, and if there's not enough to pay them, the common shares are going to get nothing. So in each of those years, they got nothing. Now we come to 2012, and in 2012, they declared 50 million. So basically, I'm going to put this down at the bottom, squeeze that a little bit more, and we're going to say 50 million how much to preferred and how much to common. Okay, well, you know from the problem, you guys told me the preferred are definitely entitled to the first 24 million. That's going to go to the preferred. And then we talked about this amount that's in arrears. They're entitled to the amount that's in arrears from prior years. And that adds up to 32. Once the preferred shareholders, so that's what they got. There's 32 for them. Once they have gotten their share, the rest is going to go to the common. Okay, so that's how it's going to be split. The 50 million, it's going to go 32 million to preferred and 18 million to common. The last thing, ask you to record an entry with the dividends payable account. This is what it would look like. You could just do retained earnings or dividends, right? Just like the other examples. For 50. And then I ask you to split the dividends payable into 2 pieces. So I can see how much in dividends payable is going to each class of stock. we'd have 18 and 32. That would be that. All right. So, I think you have some homework problems on that. Good practice if you can do it. Okay, so that takes care of it. Then we're done.